Investing in stocks falls within two main strategies. Both strategies can be used separately or at the same time. The first strategy involves buying stocks at a low price and then waiting to sell at a higher price. The second strategy is investing in a stock in order to earn dividends from it. In this video, we will teach you how to choose a successful stock in order to make a long-term capital gain. Short-term investors hold stocks for under 2 years, sometimes even just for a day, purchasing at a low price and then waiting for a quick price increase in order to sell it profitably. Short-term capital gain investors can reap substantial profits. For example, here's a table which shows the gains from short-term investors in 2023. However, predicting short-term price movements is complex. Even small announcements can cause rapid price fluctuations, which makes this approach risky. This approach is usually only suitable for seasoned investors. A safer and rewarding alternative is investing for the long term, where stocks are held for more than 3 years. Long-term investors typically focus on the company behind the stock. They look at the company behind the stock and identify whether the value of this company will increase in the long term. Over the long term, stock prices ultimately align with the company's true value, and therefore, if the value of the company will increase in the long term, its stock price will also increase. They then buy the stocks and wait for the stock price to increase. So here are 4 critical factors to pinpoint a company whose value is likely to increase in the long term. 1. Financial performance. 2. Expansion. 3. Product innovation. And 4. Management. Let's do a practical assessment of 3 well-known companies: Safaricom, KCB, and KPLC. Financial performance. KCB has had an 18.2% average profit growth for the last 5 years. Safaricom has had a 19.5% average profit growth for the last 5 years. KPLC has had a 2.9% average profit growth for the last 5 years. Now let's look at product innovation. KCB has had continuous innovation for the past few years, including KCB Mshwari, M-Pesa, Fuliza, and more recently KCB Vuma in 2020. Safaricom has also had multiple innovations, including M-Pesa Africa, M-Pesa Global, My Safaricom app, M-Pesa Super App Fuliza in 2019, M-Pesa Global Virtual Visa Card in 2020, and the upcoming Mali Wealth Management. KPLC, on the other hand, has barely had any product innovation in the past few years. Third, let's look at expansion. In recent years, KCB has expanded to Rwanda in 2021 and DRC Congo in 2022, and these subsidiaries have been doing well. Safaricom expanded to Ethiopia in 2022 and has also expanded by launching a 5G network connection. KPLC did launch the last mile connectivity project about 10 years ago, but since then there has been little expansion. Finally, management. KCB has had smooth board operations with minimal conflict and peaceful senior level transitions. There has also been minimal turnover in the board and senior level management. Safaricom has also had smooth board operations and minimal turnover in the board. There has been senior level turnover, but for routine reasons and speedy, peaceful replacements. With KPLC, the entire board has been replaced twice in the last 5 years. There has been no permanent CEO within the last 3 years, and there have been continuous wrangles between the board chair and the board members for the last 2 to 3 years. Evaluating these 4 crucial factors, KPLC's viability as a long-term investment diminishes, highlighting Safaricom and KCB as standout options. Using this as a starting point with any stock, investors can now make informed decisions as to whether a stock is a good long-term investment or not. Invest in stocks online with the AIB DigiTrader app.